My guest today is a veteran of the financial services industry. He provides strategic leadership to his company, Nicola Wealth, using passion for providing innovative solutions to clients' problems. His areas of expertise include investment management, estate and financial planning, as well as business planning with a focus on best practices for wealth building, exit strategies, and shareholder agreements. He was selected as the winner of the Ernst & Young 2011 Entrepreneur of the Year Award for the financial and professional services in the Pacific region, and was recognized as one of Canada's most admired CEOs of 2016 by Waterstone Human Capital. He is involved with many philanthropic endeavors. Another passion of his, and he has been a board member of Canuck Place Children's Hospital for the past 6 years, including 2 years as board chair. Being recognized as an expert in his field, he has been asked to speak before many, many groups and associations. Please welcome John Nicola, Chairman and CEO of Nicola Wealth. John, welcome.
Thanks, Peter. Thanks for having me.
Before we got on the air, I was admiring your library in the background, and I think you're much like me. I read a book a week.
Well, I would say it depends on the time of the year and whether we're traveling or not. But I would say, yeah, comfortably a book a week, and I try to flip between one fiction and one nonfiction, so I don't pamper myself by just getting into a whole series of detective stories or spy stories or something like that.
Do you ever give your books away, never to be returned, or are you?
Well, I've been reluctant to, and my wife has been on my case about this for like years. And then finally, like I had an epiphany on Monday. So I started boxing 200 books, and I put them into these boxes, and they're all going to be given away. And I went to my executive assistant, Lauren, and I said, Lauren, okay, would you contact Union Gospel Mission, Covenant House, Canuck Place, Take a Hike? Well, like we came up with 10 different charities that we support on a regular basis, and just let them know that we're giving away these books. And we're going to call back like within a day, and essentially nobody wants them.
Wow.
So I can't give them away because basically everybody's gone digital now, and they're not sure where they would physically put them and all the rest of that. So as it turns out, we're going to end up giving them to the Union Gospel Mission thrift shop, and that'll be sort of where they end up. But I really didn't realize it would be that hard to get rid of the books.
I never thought of that. I've got a couple of thousand books, which I keep.
Yes, yeah, that's what I have as well.
Yeah.
But I just literally ran out of space, and I still buy hard copy or hardcover books, and I have to make room for them somewhere, and my wife won't let me build a bigger house, so that's not going to happen.
Well, you're considered a veteran of the financial services industry. Now, how did you get into that business? How did you get into the financial services business?
Well, that was a complete accident. I had been, during high school and university, I'd been in a rock band with some friends of mine, and I decided that I wasn't ever going to be a professional musician. I decided it would have been in the fall of '73. I was 22 years old, and I realized I just didn't have the kind of talent. I could be a studio musician, but I could never really be, make it a career, a great career. So my lead guitarist at the time also decided to quit, and he got a job working as a salesman at Metropolitan Life. And I hated the idea of life insurance. I was single. I had no interest in it. So he came to me 3 months later and said, "Have you got a job yet?" I was working 2 jobs, washing dishes at the Keg and driving a postal truck part-time. In the meantime, he was in 1973 making $600 a month, which was like twice what I was making. And he said, "You have to come into the insurance business." And I said, "Are you nuts?" So anyway, long and the short of it is I applied in January '74 to Metropolitan Life, and they turned me down. So did Manulife turn me down, and RBC. They all turned me down because I was 22, didn't have any money, didn't have any debt, wasn't married. So in other words, didn't have any of the normal obligations you want a salesman to be motivated to provide for, okay?
Yes.
So long and the short of it is I spent my last $50 at vocational counseling getting tested for what I should do. And they said I would actually be a really good insurance salesman. I took this back to Metropolitan Life and said, my test basically trumps your test because it cost more. And the sales manager at the time, the sales manager at the time, I'm 22, he's 19. my sales manager that I eventually worked for is 19. He says, okay, I'll tell you what, he said, John, we're going to give you the job. $640 a month now. And I said, thanks. You see, I knew this test would write. He said, I didn't do this so because you think your test is right. I did this because anybody who's dumb enough to spend their last $50 trying to get this job deserves this job. And he said, from now on, all you do is exactly what I tell you to do, and you'll be the top salesman in this branch within 6 months. And that's all I did. I mean, I didn't know any better. And 6 months later, I went from making $640 a month to $600 a week. And so that was really how my career started. You know, I was 23 years old by then. And after that, I stayed within the branch system for maybe a year or two, and eventually went into the independent insurance MGA environments shortly after that. And then eventually emerged into retirement plans, and finally got into the investment side of our industry. But I started on the life insurance side.
Did you think you had those skills to be a life insurance salesman?
No, not at all. I mean,
everything
was learned. Everything was absolutely learned. I didn't know anything about life insurance. Right. So it was like an apprenticeship from the beginning.
So who influenced you the most?
Well, I mean, my friend convinced me because, I mean, I have to admit, the pay was really good at the time. And this is 1974 we're talking about. Mm-hmm. I had a really good sales manager who was very disciplined and taught me about exactly what it is in sales, any kind of sales, in order to be sure that you had a consistent flow of business. The number of calls you make, the number of meetings you have, the number of follow-ups you have, and you just don't break this model. Okay, so I didn't. Again, I didn't because I didn't really know better. In other words, I hadn't, quote, learned bad habits yet. And he made it his mission to make sure I didn't learn any bad habits. And I think the rest of it came from just saying, okay, fine, I know how to do it right. And then eventually I realized, well, maybe I do have some native talents here. Maybe I actually can have conversations with people and present things correctly. I understand the math. So I became more and more comfortable with it more quickly over time. And the rest of it, it just evolved. And it was natural that I would gravitate more to the investment retirement side, the money side, because that would be more of a fit with the way my mind works, because I focus on things that are mathematical.
Would you say he had the greatest influence on you in this profession?
No, he didn't have the greatest. It was significant. He ended up, interestingly, turning out to be the president of Zurich Life in the US. So It's not like he wasn't a talented person. He was very talented. No, my major mentor was a guy named Bill Abbott. And shortly after I left Metropolitan Life, this is 1975, a year and a bit later, I joined this independent group run by this fellow, Bill Abbott, who himself had been on the front cover of national magazines for his skill in the insurance industry. And he took me on. He already had his brother there and another young guy and the four of us worked together for a period of 2.5 years until basically he left and retired from the business and went into real estate. And Bill was my mentor. Basically, the way he worked, what he had achieved in life, everything from that, his marriage, like the whole 9 yards, to me was this perfect vision of what I ultimately wanted. In the end, I recognize that, like everybody else, our heroes often have feet of clay, and that is something that you may discover later. But in the moment, I learned more about the business and sort of life in general from Bill than anybody else. So I don't think anybody had more influence on me, certainly during my professional career, than Bill did.
So what's your philosophy about active versus passive management?
Well, it's interesting because I just listened to a great presentation between Warren Buffett and William Burry from the Big Short, the guy that shorted the mortgage market in the U.S. And generally speaking, the reason I support active investing over passive investing is that the statistics that support passive investing are based on the fact that the costs are much lower, which they are. They're when I say much lower, they're lower, but they're maybe 0.5% a year lower. They're not that much lower. And they're based on the fact that you just buy and hold, okay? And that's very interesting, except that in the real world, people don't do that at all. So in other words, it's their behavior that drives the returns, interestingly, not the size of the management fee they pay. So if you look at all kinds of studies by Morningstar, by Blackstone, by Dalbar, you're going to find that on average, the average investor earns 2 to 3% per year less than the actual indices and stocks they invest in if they just bought and held. And why do they do that? Because they buy high and sell low. What do we think they would have done last March when the market was down 36%? Would they have sold? Yeah, they did. And would they have been buying today? Yes, they are. Okay, well, the point really is that impact on your return is a multiple of the fee savings between passive and active. So the real issues for me are that the argument A is a little specious because it doesn't come to the point of what creates wealth. Managing your behavior. I mean, two guys just 25 years ago got Nobel Prizes in behavioral economics for outlining exactly why all of this is true. So if people actually understand that managing the behavior, getting the asset allocation mix right, not the passive versus active, but how much in real estate, how much in stocks, how much in bonds, how much in private assets, things like that. And then finally, people have too much money invested pretty well. When they go passive, it means automatically they're in public markets, which means they're either buying bonds or they're buying stocks, which means they're not buying, let's say, quality income producing real estate, or they're not buying quality private assets or private debt or other options, even though they represent these other assets more than 50% of global wealth, easily more than 50%. So it's almost like we're analyzing the wrong problem. We're looking for these holy grail of how do I get a better return? I should go passive versus active, and not focusing on the bigger picture of what actually drives results.
So how does one become an expert in the financial services business?
Well, now, of course, unlike when I started, there are quite a few formal designations. You can certainly get your CFP, you can get a Chartered Financial Analyst designation, you can get CIM is another designation. There's ones for alternative investments, the CAIA, there's a CLU for insurance. So in other words, you can become extremely well educated through a series of programs, almost all of which are online, so not necessarily difficult to take for anybody. You don't have to show up in class in most cases. There's a diploma course, diploma course at BCIT, which effectively gives a student a CFP when they've graduated, and then helps place them in the industry. Most of the best way to learn, obviously, is to find out about wealth management or financial planning firms, and then decide, okay, number one, do I want to, what I call, run the money? So in other words, do I want to be the one that picks the stocks and the real estate and the bonds, and I'm the one analyzing the underlying investments? So that's one category. Or do I want to be the one that's working with the individual clients about how they integrate their planning with their investments, and I'm managing the client relationship? So there's these two major paths. In our company, both of these paths exist. But if somebody were to approach us today and said, I'd like to join your firm, we'd say, okay, well, let's start by figuring out which side of these things you might ideally be suited to be on. So we go through testing with them as well, aptitude testing and abilities and all of the things that go with it, and then make a decision, which side should they start to work on? If they are literally starting out of university, they would be coming in virtually as like an apprentice. So think of somebody that wants to become a carpenter or a plumber. And there's an apprentice program. It's going to take them 6 years to get their formal designation. And then one day they become a plumber and they are a professional in that regard. And arguably, being a lawyer is the same thing. Being a doctor is the same thing. And so that's how we treat being an advisor or being an asset manager. And we would not be the only firm looking at that approach, but that would be the way for people to think of a career in our industry.
So what's strategic leadership to you in your business?
It's for us to try to figure out, what is it that we want to be? And so we ask these three questions. So the first is, and this comes from Jim Collins' material, what is our current reality? In other words, what are our brutal facts? And a complete objective assessment of where are we today? Good and bad. And then the second question is, can you answer this question? What does good look like? And I don't mean good in 30 years. I mean good in 3 to 5 years. Paint a picture of what you see good looking like in a particular area of your company. And then the third question is, all right, well, how do I get from where my current reality is to what good looks like? And that to me is what strategic planning is about. The last part is really the tactical steps you're going to take to get from that A to B. And if you have that discipline, if you were to do that process, and let's say you did that every single year so that it was rolling constantly, you evolved, you adapted to it, you adjusted to it, like we had to adjust to COVID last year.
Yeah.
So that when things fade, you make a shift, you adapt to that new reality.
So what are your top 3 best wealth building and investment management strategies?
Well, the first thing is the asset allocation, Peter. I mean, I can't emphasize that too much. It's really interesting. People who are religious, I remind them that there's something called the Talmudic asset allocation model, literally. So it's well over 2,000 years old. And it comes down to a very basic principle that 1/3 of your wealth needs to be in land or real estate, income producing. 1/3 of your land needs to be in what they call the family business. That's the pigs, the goats, the camels, the sheep, the farm, the bit. So 1/3 in business, in our case, public or private. And 1/3 of it in our term today, it would be in fixed income. Lend money to people and you collect interest, like on a mortgage or on a bond or on a term deposit and so on and so forth. And you rebalance these thirds depending on which one is doing well in any particular year. This is actually a real model that's followed by a number of investment advisors in a very simple structure. So you get that asset allocation model right, you have disciplines. That's number one. The number 2 thing is make sure that as much as 50% of your total return that you get. So let's say you're getting 7 or 8% a year. That's your objective. 50% of that should be in the form of cash flow, meaning all of your investments effectively should pay rent. So that means then the businesses pay you rent by giving you a share of their profits, in this case, in the form of dividends. The real estate gives you rents in the form, literally, of course, of rents. Rents on a building, rents on a farm, and so on and so forth. And the fixed income gives you rents, is the rent on the capital related to fixed income. And if everybody pays you rent, you have these multiple sources of income. Okay, and for you to know when you're financially independent is actually relatively simple. When the income from all of that, all sources, exceeds what you spend, you are financially, because if you took a look at last year's market, when the market dropped 36%, how much did the dividends from the companies whose price dropped 36% drop? Virtually nothing. So if I relied on the income, that 36% drop meant nothing.
Wow. Wow. How do you inspire the people who look to you for leadership within your own company?
Well, it's interesting you asked that, Peter. We're working with a new consultant who's coming in to help our own senior leadership team, which has grown a lot. I wanted to grow the team so that the base for the company, because we have a lot of people now. We have almost 350 staff in Toronto and Kelowna and Vancouver and Richmond. And so basically, with a senior leadership team, which used to be 4 people only, not even 2 years ago, is now 10 people in total. And it's a very good group of 10, but it helps if they can have some formal training in leadership development, management skills. And so we brought some people in to help with specifically that kind of work. We also recommend, and most of them have been involved in what I call peer organizations. So one of my partners, David Sung, he's a member of YPO. One of my other colleagues is in a tech group, and another one is in a CEO forum group. These are all professional peer groups, and they belong to those groups because they can compare notes with other groups from other companies on the outside and share experiences. And I think they find that really productive. So we spend a lot of time on what I call leadership or professional development. It's a key part of where we want to take the company.
So what then, leading on to that, what are your aspirations for your company?
Well, it's interesting. I used to think, okay, if I went back to when we started in 1994 and said to myself, John, you've got this 30-year vision, and you can see going from 8 people to 350 and from 80 million of assets to 10.5 billion. And I would have said, there's no way I could have even thought a fraction of that. Problem with aspirations is to say, I just want us to continually get better and let the chips fall where they may. So here's what I do know, Peter, that even now, where we are now, over 10 billion of assets, we are maybe in Canada, maybe something like one of our marketplace, or the high net worth marketplace in Canada. So we're a rounding error. There's no limitation for us, really. So we don't have to worry about, is there enough room to grow? There's more than enough room to grow. So the question is, are we worthy of that growth? Are we improving constantly? Are we getting better? Have we justified the right to have the confidence of people to become our clients? And so if we focus on that, I really don't worry about anything else. I just want the engine to work well and design itself so that it's a place people want to be as clients, want to do business with. And so that's what we focused on. So I don't tend to put it in absolute numbers. I have no idea where they're going to turn out.
Is there a minimum amount of money an individual who comes to you and wants your advice, wants to be a client of yours, has to have?
Yeah, so our minimum on our website says it's $1 million. We've been more than flexible with that, because really what our profile of client is a bit less related, because we're a financial planning organization. Our focus is on dealing with self-employed professionals and business owners. That's our fundamental marketplace, and with some executives included as well. And so if some young doctor or dentist comes along and they've just been out of dental school or medical school, and all they have is debt, and they don't have much in the way of assets, but they have a career, they have a future, then they're welcome to be on board as a client, because that's a fit for us. That's what we do. So they didn't hit the $1 million. They may not hit that $1 million for 5 or 10 years, right? So we're okay from that perspective. But generally, our average client probably has an average of $3 or $4 million with us now, in terms of household. But then obviously they're not 35 years old. They're more like 55 or 60 years old.
Is that a good age to start, 50, 55?
No, I would say, think about my own kids. Once they start earning money and actually even think aspirationally in terms of, TFSAs, RSPs, houses, stuff like that, they need to start having a plan. It needs to be way back at the beginning. That's where it's going to make the difference. So I would say 25 to 30 is the age to start at.
So if I, no, the people that will watch this interview, they will say, I need to talk to someone at your operation, your organization. Mm-hmm. How do I do that?
Well, in most cases, most of our inquiries actually come either by phone call, some by email, and then we have on our website a web inquiry form. They can go to our website and look up whatever material they want about our firm. And if they're interested in pursuing it any further, they can just complete a online documentation, and then somebody will get back to them within 24 hours and have a chat with them, and and see if there's something that we can do for them that would be helpful. So it's pretty easy to get a hold of us, and our website's probably the easiest way to locate us as well.
My last question is there any, is anyone welcome, provided they have the initial capital to invest with you? Is anyone welcome in your firm to
yeah, we're sometimes, Peter, let's say somebody comes over to us, and let's say they were, a day trader at Robinhood, just to use an example. Okay.
Yeah.
So they basically, they're literally doing buying and selling 5 or 6 times a day. And their focal point is, that's how they're going to make money. And this is where the opportunities lie. And they're going to make 60% a year. So the first part, if I have a conversation like somebody with that from the beginning, would say, look, I tell you what, why don't you keep doing that until you find out it doesn't work? But you shouldn't have a conversation with us, because we are going to be just way too boring for you. We're going to help make you wealthy, but basically it's not going to be the kind of game that you want to play. So you don't want to do business with us. I will convince somebody that we're the wrong place to be until such time as they look and say, John, your philosophy as a firm is where I'd like to move forward with. So we have to have a meeting of the minds there, or else it's really not going to work too well.
And how long have you been doing this?
I guess it's 47 years, just over 47 years. Yeah.
So you know what you're talking about.
I would hope so. Things have worked out well so far. And it's interesting. I was just noticing, because I was reading your bio, Peter. So the 44 years. So how long is it now?
For Canada-wide?
Yeah.
We're just celebrating our 46th birthday.
Okay. So same for us. So we have our 46th this year, just had it. And we had our 50th anniversary of our first date in June of this year. That was when we first met 50 years ago.
That's your wife?
Yeah, Claire.
Yeah. 50 years ago. We've been married 53 years.
Yeah, so that's, So
Yeah.
we have it'll take a while to catch up. But
Yeah. And there's nobody like my wife. I'm sure your wife is very special and just for you, as my wife is special
she's
and
unique.
just for me. Yeah.
Yeah.
John, thank you so much for taking the time. I'd like to send you my latest book, and hopefully you'll read it and add it to your library, because
I'll put it right here. See, there's a space right there.
Good. It's not quite that thick, but it's a couple of hundred pages. It's called
right,
Under the Influence.
All right,
Which is perfect for you, because you are trying to influence all these people to invest their money so it'll grow for them.
All right. Well, thanks very much, Peter, for having me on. It was a pleasure. Always nice to chat with you.
My pleasure. Thank you, John. Appreciate it. Bye-bye.